Silver just crossed into a regime where the paper price can hide the physical stress, and the next catalyst is already on the calendar. Because what you're watching right now isn't just a metal having a moment. It's a market that's small enough to be bullied, tight enough to snap, and volatile enough to punish anyone who treats it like a polite chart. And there's a reason certain voices keep trying to frame this move as a headline hiccup, a one-off panic bid, a temporary risk-off tantrum. That story is comforting. It makes silver sound optional. But the mechanism underneath this move doesn't care what's comforting. And if one level breaks, the math changes. Here is what's different about silver in a week like this. The same thing that makes it look chaotic on a chart is what makes it dangerous to be short when the wrong calendar window hits. Silver isn't like equities where liquidity is thick and everyone can find an exit at roughly the same time. In silver, the exits can vanish. The market doesn't gradually reprice, it gaps. It air pockets. And then it rips back through levels that looked impossible 48 hours earlier. Not because everyone suddenly became emotional, because someone, somewhere, became forced. And that's where the real pressure starts. If you've been watching the tape lately, you felt it. Silver stopped giving you those polite pullbacks where you can take a breath and pretend you in control. It started moving like a market that's being repriced by constraints, not opinions. That's the first clue. The second clue is the tone around it. The louder the move, the more aggressively it gets explained away. Oh, it's just trade war nerves. Oh, it's just a dollar wobble. Oh, it's just people hiding in hard assets. Those things can push the first domino, but they don't explain why the pieces on the board start behaving differently. Because when silver shifts from being a sentiment trade to being a structure trade, the chart is not the story. The plumbing is, and the plumbing is where the hidden detail lives. Most people talk about paper versus physical like it's a conspiracy poster. That's not how you need to think about it. Think about it like this. Paper sets the quote. Physical sets the pain threshold. Paper can create a price without moving a bar of metal. But physical is what forces delivery, substitution, rationing, and real-world bidding wars when supply is tight. In quiet times, paper dominates and physical shrugs. In stress times, physical stops shrugging. It starts dictating terms, and that's when the paper market has to catch up. Not because it wants to, but because it has to. But that's not the part that matters. The part that matters is the calendar. There's a reason silver squeezes don't feel like gradual bull markets. They feel like short, violent repricings that show up when timing traps line up. Month-end contract rolls, delivery windows, thin liquidity around weekends. The days when dealers and funds have to rebalance the days when options exposure flips from cushioning moves to amplifying them. And in a market like silver, those mechanical flows can overwhelm the people who thought they were trading headlines. The calendar doesn't announce itself. It just tightens the room, dims the lights, and then suddenly someone panics because the door is smaller than they remembered. So when you hear the event that could send prices to the moon, don't imagine some mysterious committee meeting or some secret vault door opening. The event is more boring and more powerful than that. It's the moment the market realizes, collectively and unwillingly, that a certain set of promises have to be managed through a narrow window, and the cheapest way to manage them is no longer available. It's the moment the market runs out of time. Because time is carry, time is roll. Time is the ability to wait for liquidity. And when time compresses, the metal stops trading like a theory. It trades like a constraint. Now, I'm not going to sell you a fairy tale that says silver can only go up. If you've been around this market for more than 5 minutes, you already know how ruthless it is. Silver will rip your face off on the way up and again on the way down. It will tempt you into overconfidence and then use one brutal wick to take it all back. That's why the question isn't, is silver going higher? The question is, what's driving price discovery right now, and what does it force participants to do over the next 1 to 2 weeks? Because that's how you stay rational when the tape turns cinematic. Let's anchor the reality first. Silver has been in a powerful upswing recently, climbing hard and fast and pushing into territory that changes how traders behave. When silver is drifting, shorts can manage. When silver is trending slowly, shorts can hedge. When silver is accelerating, shorts start counting days instead of dollars. That's the switch. And once that switch flips, you get reflexivity. Moves that create the conditions for further moves. That's not emotion, that's math. Here's the clean mechanics of that math. In leveraged markets, people don't lose because they're wrong about direction. They lose because they're wrong about timing and volatility. If you're short and the market rises, you have 3 ways to survive. You can post more margin, you can hedge with options, or you can reduce exposure. 2 of those require capital. 1 of those requires buying. When volatility rises, the capital requirement rises too. Margin goes up. Option hedges get more expensive. Liquidity thins. And suddenly the comfortable short becomes a ticking expense. At first it's annoying. Then it's dangerous. Then it's forced buying into strength. which is the worst place to buy if you're trying to be clever. But forced buyers don't get to be clever. They get to be alive. And that's where the real pressure starts. Now zoom out one layer, because silver isn't just a short story. It's a supply story. Silver is not mined like gold. A huge portion of global silver supply is produced as a byproduct of other metals, lead, zinc, copper. That matters because it means you can just wave a wand and produce more silver because the price is rising. If copper mines slow, silver supply can slow even if silver is screaming higher. If base metal capex doesn't expand, silver supply doesn't expand quickly either. Add refining and logistics lead times, and what you get is a market that can run into bottlenecks at exactly the wrong time. That doesn't guarantee a moonshot, but it does mean the market has structural fragility, and fragility is what turns a trend into a spike. Now put industrial demand on the other side of that fragility. Silver is not just a store of value metal, it's an input. It's used in electronics, in industrial applications, and crucially in photovoltaic demand chains that don't pause just because a chart looks overbought. Industrial buyers don't buy because they believe in silver. They buy because a production line can't ship without inputs. That creates a very different kind of demand. It's less romantic and more ruthless. And in supply-stressed windows, industrial demand becomes the kind of buying that doesn't care about dip timing. It cares about getting metal. But that's not the part that matters. The part that matters is how that demand collides with market structure. Let's talk term structure in a way that actually helps you. In commodities, you're not just trading the spot price, you're trading time. The market has prices for delivery now, later, and later still. When supply is abundant, the market often pays you to wait. When supply is tight, the market stops paying you to wait. Sometimes it even charges you to wait. That shift is a signal, not a headline signal, a plumbing signal, because it tells you the market is rationing immediate supply. And when the front end of the curve tightens, it changes incentives. It changes who rolls and who takes delivery. It changes how expensive it is to carry a short. It changes how expensive it is to delay procurement. It changes everything. And when that curve signal appears alongside a fast-moving spot price, you don't get a gentle revaluation. You get a scramble, because participants who normally live comfortably in paper markets suddenly have to think about physical constraints, delivery, and the cost of being wrong in time. And time is the one thing you can't print. The next detail is what flips the whole setup. There's also an institutional flow layer people underestimate. Silver ETFs and ETPs can act like pressure valves. In calm conditions, they're just wrappers. In stress conditions, flow becomes a sourcing problem. Because inflows mean metal has to be acquired and allocated. Outflows mean metal can be released, but not always in the categories the market actually needs at that moment. This is where people oversimplify. They'll say, ETFs are paper too. The truth is messier. The flows can pull on physical availability, and the timing of those flows can collide with delivery windows and tightness in a way that amplifies moves. It's not magic, it's mechanical. Now I want to address the big, spicy number everyone keeps throwing around, $400 silver. I'm not going to promise you that. Anyone promising you that is selling you certainty in a market that weaponizes uncertainty. But I will tell you why $400 doesn't need to be predicted to be respected. It's a regime shift number, and regime shift numbers don't come from a straight line. They come from compression and release. Here's a quick way to sanity check extremes without pretending you can forecast the exact path. Look at silver relative to gold. If gold is in a strong bid regime, whether because real rates are unstable, the currency narrative is fracturing, or institutions are diversifying reserves, silver often lags and then snaps. Not always, but often enough that the ratio matters. If the gold-silver ratio compresses meaningfully while gold is strong, silver can move multiples faster than people expect. Now add silver's smaller market size and higher volatility. You can go from reasonable to ridiculous on a chart without any single day looking illegal. It just looks like a series of forced adjustments. Because if this one level breaks, the math changes. And yes, macro matters right now. Trade policy uncertainty matters. Tariff headlines matter. Currency-stressed narratives matter. When markets start talking about sell America and risk premia, hard assets get attention. But macro is the wind. Market structure is the sail. Wind alone doesn't tell you where the boat goes if the sail is already straining. The sail is what rips. So let's talk why now as concretely as possible, because this is the piece people miss when they get hypnotized by the chart. The next 1 to 2 weeks are often where you see the most violent price discovery in metals. And not because the world suddenly changes every Tuesday. It's because calendars force decisions. Month-end and contract windows force rebalance. Option exposures roll, dealers adjust hedges, funds manage risk. Industrial buyers review procurement. And liquidity can thin, especially around weekends, turning normal order flow into a gap event. This is where the event can show up without a press conference. Imagine a market where a meaningful slice of participants expected to roll exposure cheaply, expected to find liquidity easily, expected that shorts could be maintained with reasonable carry costs. Now imagine that in the same window, spot has been rising, volatility has been rising, and term structure begins to punish waiting. Suddenly, rolling isn't cheap, hedging isn't cheap, waiting isn't cheap. Those are not opinions. Those are price signals. And when the market makes waiting expensive, it's telling you there's scarcity pressure at the front end. That's the quiet alarm, and that's where the real pressure starts. Now I'm going to stack the proof in layers, because in a market like this, you never want to rely on one argument. One argument is how you get emotionally hijacked. Multiple arguments is how you stay grounded. Layer one is the deficit narrative. Silver has been living with a structural supply-demand imbalance that doesn't vanish overnight. Whether the deficit is bigger or smaller in any given year, the point is that tightness is not a new invention. It's been building. That matters because it means inventories and above-ground stocks become the buffer, and buffers get thin. When buffers get thin, small changes in flow create outsized price moves. This is how commodity markets behave. They don't reprice linearly. They reprice when the buffer is questioned. Layer two is industrial demand's stubbornness. When a metal is both a monetary hedge and an industrial input, demand can show up in different costumes. Financial demand can arrive fast and leave fast. Industrial demand arrives slower but can be sticky because procurement cycles aren't just mood swings. And when industrial buyers sense risk of shortage or rising costs, they don't necessarily buy the dip. They buy coverage. They buy time. They shift from just in time to just in case. That shift alone can tighten the front end. Layer three is positioning and leverage. You don't need to know every detail of who is short what. You need to understand that in a leveraged ecosystem, risk limits force behavior. If price rises fast, volatility rises, margin rises, and short tolerance collapses. That creates an asymmetry. Longs can choose to hold, shorts can be forced to cover. When a market is tilted toward forced covering, you get acceleration. And acceleration invites more hedging, which can create more buying. Reflexivity. Layer four is institutional flow dynamics, especially via products that translate retail and institutional demand into metal exposure. When inflows occur into large products, sourcing pressure can collide with already tight physical availability. Even when metal is available, the category and location matter. Not all inventory is equally deliverable, equally accessible, or equally cheap to move. That's why a market can look fine on paper and still behave stressed in price. Because the bottleneck isn't, does metal exist somewhere on Earth? The bottleneck is, can you get the right metal to the right place in the right window at the right cost? That's the hidden detail. Layer 5 is the price behavior itself. Charts aren't magic, but they do show you where participants are trapped. When silver clears a zone that used to repel it, you often see the same pattern. Initial breakout, fast follow-through, then a sharp retest or a violent consolidation that looks scary but is actually the market absorbing supply. If that retest holds, the next leg can be faster, because sellers who were comfortable become cautious, and cautious sellers don't provide liquidity the way confident sellers do. Liquidity thins, and that's when a move that should take months can happen in days. But that's not the part that matters. The part that matters is what happens if the market stops allowing a clean pullback. Because a clean pullback is how shorts breathe. A clean pullback is how hedges get adjusted without panic. A clean pullback is how options dealers can reduce exposure without chasing. When the pullback becomes shallow, when dips get bought aggressively, when the market refuses to grant relief, the psychology flips. People stop asking, what's the fair value? And start asking, what's the maximum pain? And maximum pain is where squeezes live. Now, let's be honest about the counterpoints, because this is how you keep trust with yourself. Silver is notorious for faking out. A strong move can invite profit-taking. If broader risk assets sell off hard, forced liquidation can hit everything, including metals, even if the thesis is structurally bullish. A sudden policy shift can cool the narrative. If the dollar rips higher, it can weigh on commodities. If industrial activity slows sharply, demand expectations can cool. If positioning becomes too crowded on the long side, you can get a brutal flush. Those are real, not theoretical. And here is the most important counterpoint. Even if a Basudo moonshot is possible in theory, the path matters more than the destination, because the path is where most people get emotionally manipulated. So let's talk about that manipulation explicitly, because if you don't name it, it will name you. In silver, volatility is not an accident. It is the feature. Volatility is how the market transfers metal from weak hands to strong hands, and transfers money from over-leveraged conviction to disciplined patience. The market will use headlines as a lever. You'll see a spike, then a scary reversal. You'll see a pullback that feels like the top. You'll see a wick that looks like it's over. Then you'll see a recovery that makes you feel foolish for reacting. This cycle is how people get trained into bad behavior, buying after the move and selling during the shakeout. And the shakeout is designed to look like confirmation that you were wrong. But that's not the part that matters. The part that matters is learning to separate trend signal from noise. Trend signal is what persists across days and weeks, higher highs and higher lows, supportive retests, strengthening demand narratives, tightening front-end incentives, rising participation that doesn't collapse on every dip. Noise is the one-day headline spike, the liquidation wick, the panic candle that reverses in hours, the social media certainty that flips direction overnight. If you can't tell the difference, silver will teach you, expensively. Here's a simple shield. Always run a two-scenario lens in your head, not because you're indecisive, because it keeps you rational. Scenario 1 is the controlled pullback and retest. Silver pulls back into a prior breakout zone. Liquidity improves slightly, the market breathes, and you get a base building phase. This is where the move becomes sustainable. It's not sexy, it's where impatient people get bored and exit, and that boredom is the fuel for the next push. In this scenario, the thesis doesn't die, it matures. Scenario 2 is the continuation, squeeze, and gap risk. Silver refuses to pull back cleanly, dips get bought immediately, and then a single session, often in thin liquidity, pushes through a psychological level that forces hedging behavior. In this scenario, you can see air pockets, you can see gap moves, you can see price discovery that looks absurd, and then you can see violent reversals that punish anyone chasing. Same thesis, different path. One path is calmer, the other is a knife fight. Now, if you're watching for the event, here's how it shows up in these scenarios. In scenario 1, the event is the successful retest into a calendar window. It's the market proving that even when it tries to shake you, it can't break the structure. In scenario 2, the event is the break of a key level during a mechanically sensitive week, when funds, dealers, and short exposures are forced to react in a compressed window. And that's where the real pressure starts. So what are the levels? I'm not going to give you fake precision, but you don't need it. You need zones and behavior. When silver is ripping, there are 3 types of levels that matter. The first is the recent breakout zone, the area the market surged through when the narrative turned from maybe to now. If price revisits that zone and holds, that's a structural confirmation. The second is the psychological round number zone, levels like 100 that attract options exposure, media attention, and reflexive behavior. Those levels matter because they change how hedges are structured. The third is the panic pocket, the zone below recent lows where stops cluster and where a liquidation wick can happen if broader markets seize up. That zone matters because it ES where weak hands get removed and where strong hands often step in. The next detail is what flips the whole setup. Confirmation isn't just price up. Confirmation is behavior around these zones. Does silver hold the retest with speed? Do dips get bought on high volume? Do you see the market rejecting lower prices quickly? Does the narrative shift from why is it up to why can't it go down? Those are confirmation tells. Invalidation is equally important because it's what keeps you honest. If silver loses a key support zone and can't reclaim it, if the market starts making lower highs and lower lows, if dips stop getting bought and instead get sold harder, that's the thesis weakening in the near term. Not necessarily the end of silver forever, but the end of that immediate setup. If you can't name your invalidation, you're not trading a thesis. You're worshiping a story. Now, let's bring this back to the moonshot question. Can silver reach numbers that sound insane? In certain regimes, yes, but the only way to even approach a number like $400 is not by gradual appreciation. It's by structural repricing, where multiple forces align, macro bid and hard assets, tightening physical availability, a term structure that punishes waiting, and a positioning environment that creates forced buying. You would also likely need a narrative catalyst that keeps new participants arriving even after the first brutal run. And you would need enough volatility to shake out people repeatedly while still maintaining the trend. That combination is rare, but silver is one of the few markets that can make rare things happen because it's small enough for flows to matter and emotional enough for volatility to become the weapon. But here's the trap. When people hear $400, they start making decisions based on a destination instead of a process. That's how they get wrecked. Silver doesn't reward destination thinkers. It rewards process thinkers. It rewards people who watch what the market forces participants to do. It rewards people who respect the calendar. It rewards people who understand that the event is often a mechanical window, not a viral headline. So what should you watch next week? Not in a vague, stay tuned way, in a concrete checklist way. First, watch how silver behaves into and around psychologically important zones. If it approaches a round number area like 100 and stalls, that's normal. What matters is whether it rejects and collapses or consolidates and tightens. Tight consolidation under a key level is often more bullish than a wild spike through it, because it means the market is absorbing supply without needing a blow-off candle. If it breaks through and holds above, that's where hedging behavior can accelerate, because if this one level breaks, the math changes. Second, watch for the quality of pullbacks. Are they sharp and quickly bought, or are they slow and grindy? Sharp pullbacks that get bought quickly can indicate strong demand. Slow, grindy pullbacks can indicate distribution. And in silver, distribution can look deceptively calm before it turns violent. Third, watch the broader macro tape, not for reasons, but for liquidity. If broader markets are under stress, forced liquidation can hit metals, even if the structural story is intact. That doesn't mean silver is over. It means you might get a scenario 1 retest or even a liquidation wick before continuation. This is why sizing and time horizon matter. Price can whip around violently, even if the thesis is correct. That is not a disclaimer. It is the core truth of this market. Fourth, watch positioning sentiment in the simplest way. Are people suddenly certain? When the internet becomes unanimously confident, silver usually punishes that confidence. Not because the thesis is wrong, but because the market needs liquidity. It needs sellers to keep moving higher. And the easiest way to create sellers is to scare longs out. The market will do what it must to find liquidity. Fifth, watch the calendar, because this is the hidden catalyst. Late month windows, delivery windows, option expiries, and thin liquidity periods are when structure can overwhelm narrative. If you see a weekend coming after a strong run, respect gap risk. If you see a mechanically sensitive window with stretched price, respect whipsaw risk. The market doesn't move when you're ready. It moves when someone else is forced. Now, let's get practical on psychology, because this is where most people lose the most money. If you're the kind of person who needs to be right every day, silver is not your friend. You'll overtrade, you'll chase, you'll react. You'll let the market train you into buying tops and selling bottoms. If you want to survive this, you need one core rule. Don't let a one-day candle rewrite a multi-week structure unless the market proves it by follow-through. Silver will throw one-day tantrums. Your job is to see whether the tantrum becomes a trend. Here's a simple way to do it. If you're bullish, define your time horizon. Are you trading days, weeks, months? Then define what would change your mind on that horizon, not what would scare you. What would actually change your mind? Then size your exposure so that you can survive the volatility that is normal for silver. If you size too big, even being right will hurt you. And once pain is high enough, your brain stops thinking in probabilities and starts thinking in escape. That's when you make the worst decisions. That's how volatility manipulates you. It doesn't need to convince you you're wrong. It just needs to make you uncomfortable enough to quit at the wrong time. Now, about institutions and suppression talk. There are incentives in markets. There are hedging needs. There are positioning games. There are liquidity providers protecting books. There are periods when paper selling can overwhelm physical reality, temporarily. But the key word is temporarily. When physical constraints become binding, paper can't ignore it forever. Paper can delay the repricing. It can make the path brutal. It can manufacture shakeouts. But it can't manufacture metal on demand. It can't eliminate lead times. It can't erase industrial procurement. It can't stop a calendar window from forcing decisions. That's why the real battle in silver is not between truth and lies. It's between time and promises, between inventory and demand, between carry costs and funding, between risk limits and exposure. That's the battle that matters. So is $400 silver coming? The honest answer is not as a guarantee, not on a neat schedule, and not without a path that would break a lot of people emotionally along the way. But is a violent repricing possible in a regime where hard assets are bid, physical tightness is real, and the calendar compresses risk management into short windows? Yes, and the bigger point is this. You don't need to believe in $400 to trade the setup intelligently. You need to understand what would have to happen for silver to keep surprising people and what would have to fail for the move to cool off. Here's my base case lens from here. I expect volatility to stay elevated because when a market breaks into a new regime, it doesn't return to calm immediately. You often get sharp continuation pushes followed by scary pullbacks. If we see a controlled pullback into a prior breakout zone and it holds, that's a healthy structure. If we see refusal to pull back and we press into psychological levels with tight consolidation, that's squeeze risk. In either case, the next 1 to 2 weeks are where the market can do the most damage because the calendar and liquidity conditions can amplify everything. The next detail is what flips the whole setup. And this is where I'll leave you with a simple identity CTA that isn't T-begging. If you are you're going to play a market like silver, you have to choose what kind of participant you are. Are you a headline reactor or a structure watcher? Are you chasing adrenaline or managing a process? The people who do well in this market aren't the loudest. They're the ones who can stay calm when the tape is trying to hypnotize them. They can say, this candle is noise unless it gets follow through. They can say, this pullback is normal unless structure breaks. They can say, I'm not here to win today's argument. I'm here to survive the calendar window. If that's the kind of crowd you want to be in, the kind that respects mechanics, respects risk, and doesn't get emotionally farmed by volatility, stick around and keep your eyes on the tells, not the drama. Because silver doesn't need your belief, it needs your discipline. And if the market gives you that one break, where liquidity thins, the round number comes into view, hedges get stressed, and someone somewhere realizes they out of time, you'll understand why this move isn't hot emotion. It's math.